Let me start with a truth that Wall Street doesn't like to advertise. When you are young, time is your greatest asset. When you are over 70, certainty becomes your greatest asset. The biggest mistake older investors make is believing the same rules that applied at 40 should still apply at 75. They don't. The goal quietly changes, but most people never adjust their strategy. At this stage of life, the primary enemy is no longer inflation alone. It is permanent loss of capital. You can recover from a bad year in your 40s. You cannot easily recover from one in your 70s. This is why the first truly safe investment principle is not about chasing returns. It is about protecting what you already have. There is a simple mental shift that must occur. Growth is optional. Survival is mandatory. In investing terms, survival means ensuring your money continues to support your life, your health care, your dignity, your independence, without forcing you to make desperate decisions during market chaos. History is clear on this point. Market crashes are not rare events. They are features, not bugs. The Great Depression, the 1970s inflation crisis, the dot-com collapse, the 2008 financial crisis, the pandemic crash. Each one wiped out fortunes, not because investors lacked intelligence, but because they lacked margin of safety. Margin of safety is not an abstract idea. It is deeply practical. It means holding assets that don't require perfect timing, avoiding leverage, owning things with intrinsic value, never depending on optimistic assumptions to meet basic needs. For someone over 70, the math becomes brutally honest. If you lose 50% of your portfolio, you need a 100% gain just to break even. But time, your most powerful ally earlier in life, is now limited. So the first category of safe investment is not a specific asset. It is a philosophy. Never risk what you need for what you want. This is why speculative growth stocks, complex derivatives, and fashionable trends quietly become dangerous at this age. Not because they are always bad, but because they demand time and emotional resilience you may not be able to afford. A safe investment after 70 must meet three conditions. It must survive economic cycles. It must not depend on perfect decisions. It must allow you to sleep well at night. Anything that fails even one of these tests is no longer an investment. It is a gamble. The wise investor understands this. The purpose of money is not to impress people you don't know. It is to support a life you still want to live. Capital preservation is not pessimism. It is realism informed by experience. And realism in investing is the closest thing we have to wisdom. If I could sum up safe investing after 70 in one word, it would be predictability. Excitement is overrated. Reliability is undervalued. A steady stream of income arriving quietly, consistently, and without drama is far more powerful than a portfolio that looks impressive on paper but fluctuates wildly in practice. This is where the first truly safe investment reveals itself. Investment first, high-quality, dividend-paying businesses. Not all stocks are safe, but some businesses are built so well that they behave more like utilities than speculations. These are companies with long operating histories, strong balance sheets, essential products or services, a habit of sharing profits with owners. Dividends are not just income. They are evidence. They signal that a business generates more cash than it needs, even after paying employees, maintaining assets, and expanding operations. For older investors, dividends serve three crucial purposes. They reduce the need to sell assets during downturns. They provide psychological stability. They convert market volatility into patience. When markets fall, and they will, dividend income continues. That income becomes a bridge between fear and reason. Importantly, safety here does not mean highest yield. High yields often signal hidden risk. Safety lies in payout ratios that leave room for error, businesses with pricing power, companies that survive multiple recessions. Think consumer staples, healthcare leaders, utilities, and essential financial services. A predictable income stream allows you to plan, not hope. Hope is not a strategy. Cash flow is. This same logic extends to the second safe investment. Second, government-backed bonds and cash-like instruments. Bonds are often dismissed as boring, but boredom in retirement is a feature, not a flaw. High-quality bonds provide capital stability, predictable interest, protection during equity downturns. Government-backed bonds, treasury instruments, and insured fixed-income vehicles exist for one reason: to preserve trust. They will not make you rich. They are designed to make you secure. Cash equivalents such as money market funds or insured deposits play a similar role. They provide liquidity, flexibility, and peace of mind. Liquidity is often misunderstood. It is not about earning returns. It is about having options when unexpected expenses arise, medical costs, family needs, or emergencies. Liquidity prevents forced selling. Forced selling is where wealth quietly disappears. Predictable income removes pressure. Pressure leads to mistakes. Mistakes cost more than any missed opportunity. Keynote 3: Simplicity is the ultimate risk management tool. Approximately 900 words. Complexity is seductive. It makes people feel sophisticated, but complexity is rarely safe. Most financial disasters are not caused by ignorance, they are caused by overconfidence in systems people don't fully understand. After 70, complexity becomes a silent risk. Why? Because complex investments require constant monitoring, depend on external expertise, break during stress, fail when assumptions change. True safety comes from clarity. This brings us to the third safe investment. If there is one lesson investing teaches over a lifetime, it is this: most mistakes are not caused by doing too little, they are caused by doing too much. Complexity has a way of disguising risk. It dresses uncertainty in impressive language, mathematical models, and professional confidence. It makes people feel informed, even when they are not protected. And nowhere is this more dangerous than after the age of 70. At this stage of life, complexity stops being an intellectual challenge and starts becoming a liability. The financial world often rewards complexity with attention. Structured products, alternative assets, leverage strategies, private deals, and constantly changing allocations all promise one thing: better performance. But performance is not the same as safety, and sophistication is not the same as wisdom. True safety comes from understanding what you own, why you own it, and what could realistically go wrong. That is the heart of simplicity. A simple investment strategy does not depend on forecasts. It does know. Require constant monitoring. It does not fall apart when assumptions change. Complex strategies, on the other hand, tend to work beautifully, right up until they don't. And when they usually fail at the worst possible time, when stress is high and flexibility is low. History provides no shortage of examples. In every major market crisis, the biggest losses were not suffered by people holding simple assets. They were suffered by those holding things they only partially understood, investments that relied on liquidity, leverage, or perfect timing. Simplicity reduces risk not by eliminating uncertainty, but by removing fragility. This is why one of the safest approaches for investors over 70 is a simple, low-cost index strategy paired with sufficient cash reserves. An index fund is not exciting. It makes no predictions. It does not promise to outsmart anyone. It simply owns productive businesses across the economy and accepts reality as it is, not as we wish it to be. That acceptance is powerful. Index investing works because it aligns with how markets actually behave. Individual companies fail. Entire industries change. But economies adapt, innovation continues, and human productivity moves forward over time. Instead of asking, which company will win, you ask, will people keep working, creating, and solving problems? That question has had a remarkably consistent answer throughout history. For an older investor, this matters deeply because it removes the need for constant decision-making. You are no longer required to judge management teams, interpret earnings calls, or react to headlines. You let the system work while you live your life. But simplicity alone is not enough. This is where cash reserves quietly become one of the most underrated safety tools in investing. Cash is often criticized as unproductive. That criticism misunderstands its role. Cash is not an investment, it is insurance. Cash protects you from being forced into bad decisions. When markets fall sharply, people do not sell because they suddenly stop believing in their investments. They sell because they need liquidity. Medical expenses, emergencies, family obligations, these realities do not wait for market recoveries. A cash reserve gives you time, time to think, time to wait, time to let fear pass. Without that time buffer, even the best long-term strategy can fail in practice. Simplicity also has a psychological benefit that cannot be overstated. Complex portfolios create anxiety. Anxiety leads to tinkering. Tinkering leads to mistakes. Every additional moving part introduces another opportunity for error. Not just mathematically, but emotionally, behavioral research consistently shows that investors underperform not because markets are unfair, but because humans struggle with uncertainty. We chase performance, abandon discipline, and react to noise. A simple strategy reduces these temptations. It creates fewer decisions, fewer doubts, fewer reasons to panic. This matters even more as we age because energy, mental and emotional, is a finite resource. Your investments should not demand attention. They should support independence, not threaten it. There's another dimension of simplicity that is often overlooked: legacy. Complex portfolios are difficult to explain and even harder to unwind. They create confusion for spouses, heirs, and trustees. What feels sophisticated today can become a burden tomorrow. Simple structures are easier to manage, easier to transfer, and easier to protect. They reduce costs, they reduce errors, they reduce conflict. In other words, simplicity does not just protect you, it protects the people who may one day depend on your decisions. It is worth remembering that risk is not always visible. Some of the most dangerous risks are hidden behind impressive credentials and confident explanations. A simple portfolio may never make headlines, but it rarely makes regrets either. The goal is not to optimize returns in a spreadsheet. The goal is to build a system that works in the real world, under stress, during uncertainty, and in moments when attention is elsewhere. Simplicity is not about being conservative. It is about being durable, and durability in investing is what separates those who succeed quietly from those who fail loudly. If there is one principle worth carrying forward, it is this: the best investment strategy is the one that still works when life becomes complicated. Simplicity makes that possible. If investing were purely mathematical, most people would do far better than they do. The formulas are not secret. The data is widely available. And yet the results tell a different story. The reason is simple. Investing is not a test of intelligence. It is a test of temperament. The greatest threat to your financial security is not inflation, recessions, or interest rates. It is the moment when fear convinces you to abandon a sound plan. Every major loss in history shares a familiar pattern. Investors buy with optimism and sell with regret. They exit not because the underlying asset stopped working, but because uncertainty became emotionally unbearable. This is why true safety in investing cannot be measured only by volatility or expected return. It must be measured by one essential question: can I hold this investment when everything around me feels unstable? If the answer is no, the investment is not safe, no matter how impressive it looks on paper. Fear has a way of compressing time. In moments of crisis, the long term disappears. All that matters is immediate relief. Selling feels like control, even when it locks in permanent damage. The safest investments are designed to counteract this impulse. They reduce the urge to act by removing the pressure to react. This is why predictable income matters. When income continues despite falling prices, fear loses its power. Dividends arrive. Interest is paid. Expenses are red. The need to make sudden decisions fades. Inflation presents a different challenge. It works slowly, quietly, and persistently. Unlike market crashes, it does not announce itself. It erodes purchasing power year after year, often without emotional alarm. A safe investment must acknowledge this reality. Holding assets that can adjust over time, whether through pricing power, economic growth, or structured income, protects against inflation not by guessing its path, but by adapting to it. But time remains the ultimate test. Time reveals weaknesses that theory cannot predict. Investments that depend on perfect conditions eventually encounter imperfect ones. Those that survive are not necessarily the most profitable, but the most resilient. Resilience comes from alignment between the investor and the investment. When you understand what you own, why you own it, and what to expect from it, patience becomes easier. You are no longer reacting to headlines. You are executing a philosophy. After 70, this alignment becomes essential. Your investments must fit your life, not the other way around. They should accommodate health changes, family responsibilities, and shifting priorities without forcing drastic action. This is why overcomplication quietly increases risk. The more moving parts a strategy has, the more reasons it gives you to doubt it under stress. Simplicity supports endurance. The safest investment is not the one that avoids downturns. It is the one that allows you to outlast them. Markets have always recovered over time. Investors who stayed invested benefited. Those who left often did not return until confidence and prices were higher. This pattern repeats not because people lack knowledge, but because fear is persuasive. Safety, then, is not about prediction. It is about preparation. Preparation means building a portfolio that assumes uncertainty, not one that collapses under it. It means holding enough liquidity to remain patient. It means accepting modest returns in exchange for stability. It means valuing peace of mind as a legitimate financial outcome. There is a quiet confidence that comes from knowing you do not need to act. That confidence compounds just as surely as interest does. The ultimate purpose of investing is not to maximize numbers on a statement. It is to support a life lived with dignity, independence, and calm. When your investments allow you to ignore daily noise, they are doing their job. And when fear arrives, as it always does, you are prepared not by courage but by design. That is what makes an investment truly safe. If there is one lesson worth remembering, it is this: you don't need to be aggressive to be successful. You need to be sensible. After 70, safety is not weakness. It is strength refined by experience.